You ever see these big companies and it feels like they're constantly changing shape? One month they're buying up a smaller company, the next they're merging two divisions. It looks kind of random, right? Well, it's not. It is a highly strategic game, and they've got a detailed playbook for it. It's all about moving assets, combining forces, and managing taxes, all without really changing the core business. So let's crack open that playbook and see how the game is really played.
So here's our game plan for today. First, we're going to figure out what a reorganization even is. Then we'll walk through 3 of the biggest plays in the book, just moving some assets around, smashing whole companies together, and then shuffling who owns what. And finally, we'll look at how the pros decide which play to call. Okay, first things first. We absolutely have to get our heads around the basic difference between just selling something and doing a full-on reorganization. It all boils down to one simple question. Are you changing what you own or just the box you keep it in? So, why even bother with all this complexity? Why are companies always tinkering with their legal structures? Well, at its heart, it's about hitting a business goal, right? Maybe you need to combine 2 teams or split off a risky part of the business. It's about doing that in the smartest, most efficient way possible. And let's be honest, a huge part of efficient is financial.
Okay, check this out. This slide lays it out perfectly. A simple sale, that's a change in substance. You sell a factory, you get a pile of cash. Boom, that deal creates taxable income right then and there. But a reorganization, that's a change in form. The same people still own the same business, they've just put it inside a different corporate wrapper. The goal isn't to cash out, it's to keep the business going.
And that right there, that is the core motivation. It's the whole ballgame. When a company just changes its shape but not what it fundamentally is, the tax rules often say, okay, you can put off paying the tax bill. Think about it. If you sold assets worth millions, that's a huge tax hit. This way, you defer it. It's not about never paying tax, it's about not paying it now.
All right, let's open the playbook to the first move. This is probably the most straightforward play there is. We're just talking about moving some assets from one company to another when they're all part of the same corporate family.
So here's the cool part. Even in this simple play, there's a big strategic choice to make. The company can transfer the assets at what they're worth today, their fair market value. Now that does trigger some taxable income, which sounds bad, but it can actually be a good thing if the company selling has some old losses it needs to use up, and the company buying it gets a higher cost for the asset, which means less tax for them later. Or they can choose to transfer it at its original tax cost. This means no immediate tax hit, so you defer the gain. But the catch is, the company that gets the asset also gets that lower original cost, which means a bigger tax bill for them if they ever sell it. It's all a trade-off.
Okay, let's get to plan number 2, combining companies. This is a much bigger deal. We're not just shuffling a few buildings around anymore, we're talking about fusing entire companies into one single entity. And there are basically 2 main ways to do this. You can do an amalgamation, which is what most of us think of as a true merger, or you can do a wind-up, which is more like a parent company just absorbing one of its kids.
This table breaks it down so clearly. With an amalgamation, you take company A and company B, and they smash together to become a brand new company. AB. Poof! The original 2 are gone. In a wind-up, the parent company is the one that survives. It just kind of swallows the subsidiary whole. One of the biggest differences is ownership. For a wind-up, the parent has to own pretty much all of the subsidiary, like over 90%. An amalgamation is way more flexible. So, why do all this? Well, the tax benefits are, frankly, huge. All the assets can roll over to the new company completely tax-free. But here's the real kicker. Other tax stuff, like past business losses, they get transferred too. This is an absolute game changer. It means a company that's making a ton of money can merge with a company that has a bunch of old losses and then use those losses to wipe out its own profits and slash its tax bill.
But wait, there's more. Seriously, when you have a parent and a subsidiary combine, what they call a vertical combination, a really neat little benefit can appear. It's called a step up, or what accountants often just call the bump.
Let me just walk you through a quick example. It's pretty cool. Imagine a parent company bought a subsidiary a while back for $1 million. For tax purposes, that $1 million is what they paid for the shares. It's their investment cost on the books. Okay, now let's look inside that subsidiary. For tax, the value of all its stuff, the land, the buildings, whatever, is only $600,000. So we have this gap, right? The parent paid $1 million for the company, but the tax value of the assets inside is only $600,000.
And this is where the magic happens.
This bump rule lets the parent take that $400,000 difference and literally add it to the tax cost of some of the subsidiary's assets, like a piece of land. So why on earth does that matter? Well, it means that if the parent ever sells that land in the future, their taxable gain is $400,000 less. It's an incredibly powerful way to turn the price you paid for a company into a real, tangible tax shield for the future.
Okay, on to our third and honestly most elegant play. This one isn't about moving stuff around or combining companies. This is all about rearranging the ownership structure itself. It's often used for planning way into the future, and it's called a value freeze. So what we're talking about here is changing who gets to benefit when the company grows. You're not putting more money into the business or taking any out. You're just changing the types of shares people own, and with that, who gets the upside down the road.
Here's how it works in a classic case, like a family business trying to plan for the next generation. Step 1, the founder takes their common shares, the ones that grow in value, and swaps them for new preferred shares. These new shares have a fixed value, locked in at what the company is worth today. That's step 2. The value is now frozen. Then step 3, the company issues brand new common shares for next to nothing to, say, the founder's kids or some key employees. And now for the final step. From this day forward, every single dollar of future growth in the company's value belongs to those new common shareholders. It's an amazing way to pass future growth to the next generation without the founder having to sell shares and trigger a monster tax bill today.
So we have these different plays in the book, right? Moving assets, combining companies, freezing value. But how in the world does a strategist decide which one to run? It's definitely not a guess. It's a very methodical process. The game plan is really a loop. It's trial and error. You start by getting crystal clear on what you're trying to do. Are you trying to merge two businesses, protect a certain division from risk, plan for passing the company down? Then you pick one technique from the playbook and you model it all out. You look at every single tax consequence, both for today and for 10 years from now. You have to ask, does this solve our problem without creating 3 new ones? And if the answer is no, you go right back to step 2, you pick another play, and you run the numbers all over again until you find the one that fits perfectly.
And that really brings us to the big question that hangs over all of this. When we see companies pull off these incredibly complex moves, are they just engaging in smart, totally legitimate financial planning, or are they just masters at finding and exploiting loopholes to pay as little tax as possible? The truth, like with most things in this world, is probably somewhere in the middle, hiding in the very fine print of the playbook itself.